Welcome back, everybody, to another episode of In the Money. I'm Constantine Vrondopoulos with Fidelity's Trading Strategy Desk. And with me today, Tony Zhang, Chief Strategist at OptionsPlay. Tony, it's been a couple of weeks. How are you doing? Good to see you.
Thank you so much, KV. It's been nice to have some time off, but it's great to be back, especially on a day like today where markets are quite volatile.
Oh, my goodness, absolutely. There's plenty to discuss for sure. We're back in the saddle, essentially, from last week's hiatus. We were celebrating Independence Day here, 4th of July. The interesting part, Tony, is that we haven't done the show in a couple of weeks, and in the past couple of weeks, the S&P 500 has done quite well, closing at a brand new all-time high yesterday, given some of those gains up today, but we are up 2 weeks running, a little bit better than 2% to the upside. In the meantime, the 10-year Treasury note, the TNX, the Chicago Boards of Options Exchange Treasury yield, topped out somewhere just shy or under 4.5%. We're sitting at 4.28 on the close yesterday, and of course, with the deluge of some important economic data this morning, we're now sitting under 4.2. So from the perspective of 2-week change on the 10-year Treasury yield, we're slightly lower, but not substantially so. Obviously, we're about to embark on a brand new Q2 earnings season. Time is flying by. We're already through the middle of the summer. What are you honing on or honing into, specifically, given how much information is coming at us from all sorts of angles these days?
Yeah, thank you so much, KV, for that summary. But you're absolutely right. The two things that we're really honed in on right now is the kickoff of earnings season. You had Delta and Pepsi report this morning, giving us a bit of a glimpse into the consumer. But really, kind of the big news here this morning was the inflation print that came in cooler than expected, especially if you look at specific categories within that print, such as used car sales, that were coming in substantially better than expected. That drove a lot of positivity from the bond markets with regards to pricing in now 2 rate cuts for the rest of this year, one in September and one in December. And obviously the equity markets are taking that in stride, or at least certain parts of the equity markets have been taking that in stride. We have seen the sectors that have been driving this markets higher, predominantly technology, discretionary consumer communications, really take a back seat today. You see a lot of outflows into those 3 sectors that have been leaving the markets higher, and that flow has been going into all of the rest of the sectors that have lagged behind. You see small caps up nearly 3% here, while the NASDAQ down 2%. As you said earlier today, I don't know the last time I've seen some type spreads like that. You have home builders up 5%. You have semiconductors down 3%. So really, we've seen this shift of where money has been flowing into for the past 8-9 months, flow out of that and into all the places that money has not flown into. So this is really something to pay attention to here right now as to whether that can continue. I do think that overall that type of rotation is actually healthy, because what we've been talking about for the last 6-7 months, I feel like a broken record, is just how narrow this equity market or the rally we've seen in equities have been, and narrow markets are not particularly healthy. So you need to see rotation, you need to see the rest of the market play catch up, and that's what we're seeing on a bit of an extreme level here during today's market. We'll have to see whether that continues. I think that overall, we still have to pay attention to valuations. You have the S&P 500 trading at 21 times forward earnings. That's a pretty significant premium to the median average, which is only 16 times forward earnings. So that's a 31% premium to the old long-term average. So earnings expectations going into this particular quarter are quite high. So unless corporate profits continue to rise at the same pace that they've been over the past few quarters, there are some downside risks. You see that today with Pepsi and Delta, missing on earnings and the stock getting hit pretty hard. So these are some of the things that we're concerned about, especially something that is starting to play out here today, which is the fact that the Nasdaq 100 has made a new high yesterday. There was a lot of negative divergence, higher highs in price not being confirmed by higher highs in momentum. That usually means that the upside from here is fairly limited in sectors such as technology. But some of the things that we're really starting to play out is that rotation, and that's really what I'm looking for that to continue over the next few weeks.
Yeah, Tony, thank you for that. Hats off to you, by the way, for paying attention to this. It's been in our purview for quite some time, but today maybe is day one where it's actually playing out and playing out in spades so far. With that cautious outlook on, let's say, the U.S. tech sector, given the recent price and momentum divergence that you're noting, where do you go? Where do you go from here to find your options trade ideas? What's on the docket today?
Yeah, I want to take a look at semiconductors, specifically Taiwan semiconductors, because overall we're in a bull market, right? Inflation's moving in the right direction. We're in a bull market, and right now there's a lot of investment going into AI. So Taiwan Semiconductors is one of the few semiconductor stocks that, in my opinion, are still trading at a reasonable valuation, and Taiwan Semiconductors is positioned quite well for growth, considering it is the foundry that almost every other every chip maker, including NVIDIA, uses to make their chips. So if you look at a chart here for Taiwan Semiconductors, it recently broke out above a double top at 184 to a new all-time high, and it did it on high volume. And if you look at the outperformance relative to the markets, what it's showing you that not only is it outperforming, momentum is also starting to turn positive. So you have a lot of positive signals that we're starting to see from the Taiwan Semiconductor stock chart. But I think the real story here is actually the underlying fundamentals here, because all the other AI related semiconductor stocks are trading at 30, 40, sometimes even higher than that in terms of forward earnings. Taiwan Semiconductors trades at only 21 times forward earnings. That's in line with the rest of the S&P 500, despite the fact they're expecting to grow EPS by about 23%. They're expecting to grow revenues by about 22% over the next few years. That's nearly triple what the average S&P 500 stock's growth rate is expected over the next few years. Yet it trades at the exact same multiple as the rest of the S&P 500. And that's not even mentioning the fact that of the industry-leading margins that they have of 38%. This is a company that's extremely profitable for every dollar that they make in terms of revenue. So this is really where I think this is a pretty rare scenario where the technicals and fundamentals align with the overall thesis of what the market is currently paying attention to with regards to kind of investments in AI. And I think semiconductor stocks is one of the few places where revenue is being generated today on the back of AI, and that's why I think it's one of the industries that are worth investing in with regards to the AI related theme. So the way I want to play this here is the fact that right now options on Taiwan Semiconductors Taiwan Semiconductors is not inexpensive. So I think this is a good opportunity to sell premium here. I'm going out to the August expiration and I'm selling the 190, 175 put vertical. So I'm selling the 190 puts and buying the 175 puts. Net earlier today, I can collect that for about $6.05. Now that was based on pricing closer to the open. Now, obviously markets have moved a lot here today. You could potentially adjust these strike prices down by about $5 because the stock has moved down by about $5 today and still collect roughly about the same price, around $6 for this $15 wide credit spread. And this type of strategy gives you a potential reward of $605 if the stock stays above the short strike of 190, and it has a maximum risk of $895 which is the difference between the $15 that you're of the credit spread minus the $6.05 that you're collecting in income. That's your total risk. And this benefits from the current high implied volatility of Taiwan Semiconductors and aligns it with the kind of neutral to bullish stance that I'm currently taking here with Taiwan Semiconductors now that it's broken out to a new all-time high and trades still at a very reasonable valuation.
Yeah, Tony, you're going out a little bit over a month. The monthly expiration in August, that's the third Friday of the month. Just wanted to mention that for our listeners, it would be worth noting that Taiwan Semi is expected to report earnings on July 18th. And it's also important to understand that it's an ADR, an American Depository Receipt. So it's a company that is domiciled outside of the United States. Therefore, if you're looking for the news wires on their results and what they could potentially mean for the stock, be on the lookout for those news to be hitting the tape the night of the 17th going into the 18th. So early morning hours, usually in Taiwan at around that makes it 2 a.m. Eastern approximately here in the United States for that report to come out. You might be wondering what an ADR is, an American Depository Receipt. Well, essentially, it's a product that allows U.S. investors to gain exposure to a non-U.S. domiciled listed stock, a foreign stock. And by doing so, by trading these particular products, you're avoiding some of the complexities that you have to deal with if you're dealing with foreign stock markets. What I would encourage everyone in the audience to do is to go out to fidelity.com and type in ADR Alpha Delta Romeo into the search or get a quote top right-hand side corner of our website and look for the article that is called Understanding American Depository Receipts. It's a very easy, quick read, but it's going to be worthwhile for sure. Things to be aware of, foreign exchange risks. You're investing in these ADRs in dollar terms here in the United States. Geopolitical risks potentially associated with that region currently. So plenty of things to be on the lookout for and be aware of on top of the investment thesis overall. Back to Tony's options trade, though, Tony. I wanted to mention that this is a bullish neutral strategy. You're taking advantage of a relatively high implied volatility level right now on those front month options. And naturally, there are kind of three totally acceptable outcomes, right, for the strategy to work. I mean, a stock is down small. It is moving sideways, kind of in a choppy fashion here between now and expiration, or the stock is moving up. In all three of those scenarios, you're going to be very likely potentially benefiting with this trade, especially if you're thinking about implied volatility coming down after the binary event on the 18th. Tony, I am going to be hosting the In the Money next week. I'm going to be back here with you. So maybe we can take a look at this guy next week and see if it needs any management, depending on what's going to happen with price between now and then. But let's take a look at the second trade. Curious to have what else you're bringing to the table, sir.
Yeah, I want to take a look at, we'll stick with the AI theme for the second trade, but I want to take a look at Apple because we've seen a pretty incredible run here over the past few months. Less than 2 months, the stock's up over 38%. That's an impressive run, but I think that this is a stock that may be starting to outpace the fundamentals. And I think it warrants a bit of caution here, especially for a lot of investors who may own Apple stock in their portfolios. So by all measures, the stock is technically overbought. It's trading at 17% above the 150-day moving average. Those are levels that we haven't seen since the very early days of COVID, and there was a lot of excitement around people being stuck at home, and consumers were purchasing goods with money that they were getting from the government. However, if you look at the markets, if you look at a chart here of Apple, by all measures, it's overbought. You have technically overbought looking at momentum with RSI. You're starting to see negative divergence as it reaches new all-time highs, basically a higher high in price that's not being confirmed by a higher high with momentum. It just simply means that the upside from here looks fairly limited. But just like Taiwan Semiconductors, where the fundamentals is the real story, that's the same thing here with Apple. It's trading at 31 times forward earnings. That's about a 50% premium relative to the average S&P 500 stock. Yet, when you look at what are analysts expecting growth rates to look like for Apple, they don't look particularly strong. We're looking at EPS growth that's about 9.5%. We're looking at revenue growth that's about 4.5%. They recently just announced, I think earlier today, that to suppliers that they're expecting to ship roughly around 90 million units of iPhones in the second half of 2024, and that's compared to 81 million that they had in second half of 2023. So that's about a 10% increase, which is great to see in terms of iPhone sales coming back to life, considering earlier this year we were expecting potentially declines of iPhone sales. That's a pretty significant turnaround on the back of the AI investments that they've made for this year. However, the stock's run 38%. That's a pretty significant margin above, the relatively 10% growth they're expecting in iPhone sales over this year as a result of that AI investment. So this is really where I think you look at the fact that they do have strong margins of 26%. It's just not enough to justify the stock trading at a 50% premium relative to the rest of the market when the growth rates that are expected are really not much higher than the rest of the market. So I think for a lot of investors who own Apple stock, the best way to potentially play this is to look at selling a cover call. And what that allows you to do is to collect a little bit of premium, get a little bit of downside protection while still maintaining upside exposure here in the underlying stock. So I think I'm advocating going out to the August 23rd weekly expiration and selling the 250 cover call. Earlier today, you can collect about $2.20 for this cover call, which yield at the moment about an 8.5% yield on that cover call, and compare that to this stock that pays about a 0.4, 43 basis points in terms of dividend yield. You're looking at yields that are orders of magnitude higher than what you're collecting in terms of the dividend, yet it still gives you about a 10% upside. If the stock trades up to 250 by that August 23rd expiration, you're looking at about another 10% upside from where we're trading. That would effectively mean that if the stock gets called away at 250 by the August 23rd expiration, if you sell this cover call, that you're effectively selling the stock at about 34 times forward earnings, which I think is a very reasonable valuation to be selling your stock that you own at, given the underlying fundamentals that it's currently trading with.
Yeah, Tony, that's fantastic. I mean, look, not very frequently we see a stock of this market capitalization size at the beginning of May trading around 170, going to 225, right, by the second week of July. So it was a massive move to the upside. And the question that I think everyone has in the audience is, okay, well, we know that Apple was at a new all-time high yesterday as of yesterday's close. Now, with today's sell-off, or maybe the beginning of a little bit of a rotation, it sold off over 2% off of that high. Would you consider still selling a call against the stock at this moment into this expanding implied volatility environment going into earnings on 8/1, on August 1st?
I think even more so, I think we have a little bit of confirmation that there is a bit of a temporary top here. And I think that's kind of where the neutral part of a cover call plays into the strategy that I have, or the outlook that I have here. And the higher implied volatility right now simply means I'm going to collect a little bit more premium. And this is for if you intend to remain a long-term investor of Apple, right? If you own the stock and you intend to be a long-term investor, this is the type of strategy. Unless if you're very short-term, you're very tactical, you might want to consider other strategies such as buying puts or buying some protection here to the downside. But for at least for me, for investors who are long-term investors and you're not necessarily concerned about short-term volatility, this is a great way to bring in some yield. Like I said, the dividend, you're getting about less than 50 basis points here. You're getting upwards of about 8.5% annualized yield on a cover call. And I think that's really the type of yield that I'm seeking for in this type of environment.
Perfect. Tony, we do have a look back at a trade that was put on several weeks ago. It looks like it's a winner. Tell us a little bit more on what you're doing.
Yeah, a few weeks ago, we looked at a bullish thesis here on American Express. And at the time, we bought the 222.40 call vertical. At the time, we put that on for about $6.40. And just at the open today, actually, we tagged that upper strike, that 240 strike, on the open. And earlier today, this 222.40 call vertical is trading about $14.30. That represents a return of about 123% of the initial investment. And I think, generally speaking, when you have more than 100% gain on these types of debit type spreads, and you've reached your upper strike, those are good opportunities to potentially start taking some profits on your trade. So that's what I think we should be doing and moving on to the next trade.
Tony, there's definitely a good lesson in this exercise here for all traders and listeners out there. I mean, as options traders, we don't only focus on managing risk and managing, maybe losers, trying to figure out what we do from there, but we also manage winners. This particular trade is interesting here, Tony, because it has about a week left to live, a week and a day, expiring July 19th. And it just so happens that American Express is actually reporting earnings on July 19th or that morning. So Tony's closing this trade out at a pretty substantial profit instead of kind of flipping a coin and going into that binary event with the profit from the position of risk. So very interesting. Tony, I'm curious, as well as everyone who is listening. As I mentioned, we will be back on July 18th next week on Thursday together. What should we be looking forward to in terms of economic announcements or particular earnings reports that are most of interest to you between now and then?
Yeah. Yeah, so now that we've got the inflation print behind us, all eyes, in my opinion, are on the kickoff of earnings season. You do have some major banks that report tomorrow, but you have the rest of the major banks that report early next week. You have, some United Airlines, you have Netflix that are reporting next week. But I think the big one is really the banks. The banks are going to give us a read on consumers. Jamie Dimon from JP Morgan usually gives us a pretty good synopsis of what his expectation is from a consumer outlook perspective. And then we also get retail sales next week. That's going to give us a read on kind of the strength of the consumer. So those are some of the things we're looking forward to next week, and we'll digest that on our call next week.
Excellent, Tony. This brings us to a close. I want to thank everybody for showing up and tuning in. Don't forget about the Trading Strategy Desk led follow-up to this presentation. Takes place on Fridays at 1:30 Eastern Standard Time. You can sign up for that particular coaching session by going to fidelity.com/in the money follow-up. In the meantime, don't forget to sign up to the Fidelity Active Investor newsletter. You can sign up by going to fidelity.com/active investor weekly. We'll see you back here next week for another episode of In the Money. Take care until then. Tony, thanks so much.
Thank you so much, KV.